If you think the defense rally has already happened, think again. Because the biggest opportunity in defense may still be ahead of us. Yes, hear me out. India has the world's third largest military, but it spends only around $87 billion on defense, versus nearly $1 trillion by the US and $300 billion by China. That gap is huge. It is closing in fast, and it is exactly where the investment opportunity is hiding. Defense budget has grown to 7.85 lakh crore. Defense exports have jumped to record highs of 62%. Domestic manufacturing is being pushed aggressively by the government, and this is already showing up in the numbers. Private defense companies are expected to grow 16 to 18% in FY26 after delivering 20% annual growth in the last few years. Goldman Sachs is even estimating 32% annual earning growth for the sector. So this could be a structural decade-long shift. And the real question is not whether defense will grow or not, it is which companies could capture that growth. So we did the homework. We studied the sector, went through the numbers, and narrowed it down to 5 defense companies that sit at the heart of this opportunity. Hi, I'm Aparna, and in today's video, we will look at these 5 defense companies one by one. We will decode what is changing in each business and what investors should watch before making any decision. So let's get right into it. Let's start with stock number 1, Zen Technologies. They help soldiers train without stepping onto a real battlefield with simulated and virtual ranges. But Zen is not just a training company anymore, and this is where it gets interesting. In today's warfare, drones are everywhere. Every military in the world right now is trying to figure out how to deal with this threat. How do you spot a drone? How do you track it? How do you bring it down? That's the second business Zen is building, anti-drone systems. Recently, the government gave Zen a license to actually manufacture air defense cannons of certain specifications. This license means they can now make real physical hardware. That's a completely different level of business. And the market reacted immediately. The stock jumped over 33% in a month, touching 1,825 rupees at one point. It's currently trading around 1600 at about 57 times P. That kind of valuation tells you the market is treating this like a high growth tech company, not a regular manufacturer. And the orders are backing it up. The Ministry of Defense gave Zen Technologies a 404 crore order for anti-drone systems and training simulators. In Q3 FY26 alone, the company won 586 crore of fresh orders. And after December, another 345 crore came in. That means in just a few months, order inflows reached 931 crore. And the total order book now stands at 1427 crore rupees. The financial numbers are also moving in the right direction. Revenue in Q3 FY26 grew 16.8% year-on-year to 177 crore. Profit after tax grew 30.6% to 55.7 crore. And the margins are improving as higher value anti-drone products make up a bigger share of the mix. Now let's look at the risks, and they are worth understanding clearly. This business runs on government tenders. Zen doesn't decide when it gets paid. The government's procurement timeline does. If orders get delayed, revenue gets delayed. The other thing to watch is working capital. Gross current assets are at around 450 to 500 days, which is high. What that practically means is that even when the company is growing fast and winning big orders, the actual cash can take a long time to come in because defense projects have long testing and approval cycles before payments are released. So the story here is strong, but patience is required. Okay, now let's move on to stock number 2, which is Astra Microwave Products. It is the company that builds the critical electronic parts that make modern defense systems work. Radar, electronic warfare, satellite communications, secure radio systems. These are the technologies that sit behind every modern defense system, and most people never even think about them. But without this layer, nothing works. That's what Astra builds. The stock is currently trading around 1,100 rupees at about 66 times P. That's a premium, and the reason is simple. This kind of deep technical capability is rare, hard to build, and India genuinely needs it. Now here's the shift that's happening in India's defense sector that makes Astra particularly interesting right now. For a long time, India's approach was to import technology or do basic transfers from foreign companies. That's changing. The government is now specifically favoring companies that have built their own R&D and own their own intellectual property. Astra's management has spoken about this directly. The rules of the game have changed, and companies with genuine technical depth are now getting the preference. And Astra is clearly in that category. They recently signed an MOU with BEL, one of India's biggest and most established defense electronics companies, to jointly develop and manufacture advanced systems across electronic warfare, radar, satellites, and telecom electronics. Then there is the joint venture with Israel's Rafael called Astra Rafael Comsys. This JV just won a 250 crore order from HAL to supply software defined radios, basically next generation secure communication systems for the battlefield within 18 months. This is a first move in a category that every modern military needs. Financially, Q3 FY26 standalone revenue came in at 258 crore with EBITDA of 80 crore. The standalone order book as of December 2025 stands at 2,226 crore. Now look at the mix of that order book. Astra isn't dependent on one type of product or one customer. It's spread across radar, electronic warfare, space, weather systems, and global markets. There's also a strategic move developing. They plan to split off its space, meteorology, and hydrology businesses into a separate entity. The idea is that each segment can then grow independently and investors get much clearer visibility into what each part of the business is actually worth. This kind of demerger can unlock value that's currently bundled together and hard to see. The risks are similar to what we saw with Zen: tender based revenues, long project timelines, and working capital pressure because defense approvals and clearances take time before payments come through. These are structural features of the sector, not just specific to Astra. Now let's move on to stock number 3, which is Apollo Microsystems. It's doing something that very few Indian defense companies have pulled off. It's moving from being a parts supplier to building complete weapons. That shift is where the real money is. Margins are better, strategic value is higher, and the government naturally wants fewer dependencies on foreign companies for finished weapons. Right now, Apollo is working across naval mines, anti-submarine rockets, aerial bombs, and torpedoes. Market cap is around 10,000 crore. Stock is trading near 285 rupees with an order book of over 1300 crore. The big news recently was a government license allowing Apollo to manufacture and test high caliber arms above 12.7 mm. This is a genuinely significant step. The stock jumped 23% in just 2 trading sessions when this news came out. And this license isn't out of nowhere. Apollo has been quietly building toward this. But the risk here is real and worth being honest about. Making complete weapons is much more complex than making components. There are more regulatory hurdles, longer timelines, more capital required, and more things that can go wrong. If converting this new capability into actual production orders takes longer than expected, the stock could correct meaningfully, especially after the sharp run up. This is a high potential, high risk situation. Okay, now let's move on to stock number 4, Centum Electronics. It sounds like a regular electronics company, but what it does is actually very different. It designs and builds high reliability electronic systems for defense, space, and aerospace. And in those sectors, reliability isn't just important, it's everything. Standalone revenue in Q3 FY26 came in at 238 crore, up 27% year on year. And the growth is being driven by defense and space, specifically radar systems and electronic warfare. There are active opportunities in the 700 crore range, which shows the company is starting to go after larger system level contracts rather than just component supply. Centum made the decision to exit its Canadian business and restructure its French operations. These weren't great businesses, and the company took significant one time charges to clean them up. That's hit the consolidated profitability numbers. But the underlying India business is growing well, and the balance sheet is getting cleaner. A new facility is also being built at the Bangalore Aerospace Park, specifically for advanced systems integration, which is exactly where Centum wants to take the business. Now, let me tell you what the real moat looks like here. Centum has 10 to 15-year relationships with DRDO and ISRO. You can't just walk in and start supplying to these organizations. It takes years to build the trust, get the approvals, and prove your reliability. And once you're in, the relationship is very sticky. 80% of their products are single source supplied. That means for those specific programs, Centum is the only approved supplier, there is no competition. 600 design engineers give the company the ability to keep moving up the value chain from components to subsystems to full systems. And 65 to 70% of revenue comes from exports, which adds geographic diversification and proves that international defense customers trust the quality. The stock has done well, around 73% returns over the last year, recently touching a 52-week high of 3,140 rupees. It's currently trading near 2,833 at a market cap of around 4,100 to 4,200 crore. PE is at 75 times versus an industry average of 31 times. That's a high valuation and it's priced in a lot of good news already. What justifies the premium is the moat, the relationships, the single source position, the design capability, and the exports mix. But what the risk is, and this is important, is that at 75 times, the market is assuming everything goes right. Execution on large defense programs needs to be smooth, order inflows need to stay consistent, and the cash conversion cycle, currently around 134 to 140 days, means a lot of capital stays locked up in the business before it converts to actual cash. If the execution is there, Centum is a genuinely special business. If anything slips, the valuation leaves very little room for error. Okay, now it's time to move on to the last stock on the list, which is stock number 5, IdeaForge Technology. And this one, I want your full attention to understand the clear picture because there are two very different stories happening at the same time here. IdeaForge builds drones, UAVs or unmanned aerial vehicles which are used in defense, border surveillance, disaster response and mapping. They were one of the first serious drone companies in India and they have built real products that real customers actually use in real situations. The opportunity in front of them is genuinely large. India is pushing hard for domestic drone manufacturing. Defense demand for UAVs is increasing fast and IdeaForge has the early mover advantage. The relationships, the product track record, everything. Q3 revenue came in at 31.5 crore, up 79% year on year, a strong jump. Order inflows in FY26 totaled 440 crore rupees. The current order book sits at 350 to 370 crore. Revenue is split 42% from defense and 58% from civil segments. So there's a mix of institutional and government demand. The stock has been moving sharply, 7% intraday spikes, trading around 539 to 561 rupees. Clearly, there's a strong market interest. But now, here's the honest side of this picture that you need to know. IdeaForge is still loss-making. The company is not profitable yet. So traditional valuation measures like P don't apply. The market is valuing this entirely on future potential, not current earnings. Rating agencies have flagged concerns, operating losses, revenue volatility because a lot of demand comes from emergency government procurement, which is lumpy and unpredictable. Heavy dependence on tender cycles, and there's also promoter pledge activity, which means some promoters have pledged their shares as collateral, something the market always watches nervously because it can add pressure if the stock falls. The stock is currently around 515 rupees with a market cap of about 2200 crore, still below its 52-week high of 660 rupees. So how do you actually think about this one as an investor? The long-term story is real. Drones in defense and surveillance are not going away. If anything, they are going to become more important. IdeaForge has the positioning, but it needs to prove it can convert that into consistent revenue and eventually into profitability. Three things to watch specifically. One, can they execute the existing order book? Management is guiding for 40 to 45% of execution in the current quarter. 2. Are new orders coming in consistently or is it dependent on one-off emergency procurement cycles? And 3. When does profitability actually come? Because until the company starts making money, the stock will always be driven more by sentiment and news flows than by actual fundamentals. High potential, but you need to go in with eyes open on the risks. So let's just take a step back and look at what we've actually covered today. 5 companies, 5 very different positions in India's defense ecosystem. Each one is at a different point in its journey, carries a different risk profile, but is benefiting from the same underlying shift. India is serious about building its own defense capability, and that is not going to reverse. Now we want to hear from you. Which of these 5 companies are you most interested in and why? Drop it in the comments. We read every single one of it. Also, if this video helped you think more clearly about the defense sector, please like it and share it with someone who's tracking this space. And subscribe so you don't miss our next deep dive because we have a lot more coming. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.